Hey guys, this is the Trading for Dummies series brought to you by Mastermind Trading. Introduction. In previous videos, we've considered some of the basic concepts of price action trading and technical analysis. Now in this video, we want to look at a very important concept, which is risk management. If you've done any form of trading at any point in time, you would be able to tell that without a doubt, trading is not without its risk. In fact, trading comes with a lot of risk because most of the time, or all of the time, you have to be risking something that is first yours in an attempt to make something out of the market. In the most basic sense, I like to define risk management as those protective framework which a trader puts in place to make sure that they reduce risk as much as they can while looking to maximize profits as much as they can. So risk management is basically those measures, those steps, those works put in place to make sure that if things go south, you don't get to get blown out completely. There are quite a number of ways that traders have devised for reducing risk as much as they can. That's what we'll be looking at in this video. First here is portfolio diversification, and portfolio diversification basically refers to a trader choosing different asset class for different assets, with the objective being to maximize returns on each asset class with an attempt to minimize the risk profile on them. So basically, a trader can choose to classify his holdings, his investments, based on their risk profile, based on for whatever reason, but you can basically diversify your portfolio into maybe short-term risk, long-term risk, high risk profile, short risk profile. Okay, this particular investment category, I'm going to be risking, the risk profile is high, so I know that whatever it is I am putting here, I will need to take my mind off it 100%. But it is classifying investment or assets based on their risk profile and levels. The second method here is called hedge, and hedging in the financial world basically means holding one as asset in an attempt or as an attempt to mitigate or reduce the risk of another investment or asset class. So let's say I am holding gold because I have a stockpile of cash in the bank, and I'm afraid that the value of my cash in the bank would go down. Now, in an attempt to say that if tomorrow the value of this cash, this $1 million I have in the bank, is no longer $1 million, I have a gold that is appreciative in value to make up for the loss I have incurred from the loss of value of this investment I have in the bank. So it's basically holding one investment that has the tendency of higher return as a hedge, as a protection over another investment that has a less return and has a much higher risk profile. Third here is stop loss, and if you are a trader, this is one tool that you are going to find very helpful and very useful in the course of your trading. Basically, a stop loss order is an order or an instruction that is placed on a trade to say that if the market goes against me to this degree, take me out of the market completely or not completely, whichever way, just depends on the trader's preference. But a stop loss order is some sort of a counter order that is placed as a protection over your trade that is currently running. Now, I do believe that if you are going to be trading the market actively, stop loss is one thing that you should never neglect. You should always go into a trade with a stop loss. And I do believe that if you say you use a mental stop loss, you are most likely mental. Never forget to use your stop loss if you are going to be trading the global financial market. Next, when it comes to risk management, is position sizing. And position sizing is basically deciding what portion of your account size you are going to be going into a particular trade with. Now, there are different methods that traders go about position sizing. Usually, there is the say that you should not go into any trade with more than 2% of your account size. I personally don't recommend that. I don't usually champion that because I really don't know what your account size is. 2% of a $10,000 account size is a significant amount. It's a good trade. It's a significant amount basically. But 2% on a $100 or $200 account is insignificant. So my grand rule for position sizing is let the determining factor when it comes to where how you size your trade be the distance from your entry to your stop loss. If you have a trade that has a larger distance from entry to stop loss, you really don't want to be going into that trade with your entire account size. Meanwhile, a trade with a smaller risk profile can take a larger position sizing. So that's basically my own rule for position sizing. You would have to figure out what works best for you based on your account size and every other factor, and then put that in place. As a trader, one market condition you are going to be experiencing quite often is this high volatile market conditions. And while there are really no cures to very volatile market conditions, except maybe avoiding them entirely, which I don't recommend because I don't think the best sailors are made in shallow waters. Now, one thing that you would experience quite often in very volatile market conditions is slippage. And slippage is basically that situation whereby you place a order, either a buy or a sell order, at a particular price, and then because of maybe instant increased market volatility, your order gets filled at a different price. In some cases at favorable price, in a lot of cases for most traders in unfavorable prices. But slippage is the difference between that price which your order was supposed to be initially filled and the price at which it is now filled. One good way of mitigating this risk is by always making sure that you have a stop loss order to protect you on every trade. Otherwise, maybe just watch your trade, watch your order. I remain Monaco Daniel, the mastermind trader from the world most populous Black Nation. See you in the next video.